Well, good morning and welcome to the Reserve Bank, and thank you for joining us. With me, I've got John McDermott, who's the Chief Economist and Assistant Governor, and also Willie Chetwin, who's the head of the forecasting team. And a special welcome to 4 young men from Westlake Boys High School in Auckland. They won the Reserve Bank's Monetary Policy Challenge, which is basically a contest that we run amongst high schools around New Zealand. In this case, there were 67 high schools, and we asked the teams to assess the economic outlook and make monetary policy decisions. So the lads from Westlake can take all the tough questions, but they can especially answer about Auckland housing prices, which I'm sure will get asked. But just a few opening comments. The economy is growing at an annual rate of over 3%. The strong momentum is driven by high export prices. Our terms of trade are at a 40-year high, and dairy prices are up 50% this year. Private consumption is growing strongly, as is investment, which is driven by the reconstruction work in Canterbury and residential building elsewhere. Continued fiscal consolidation and the high exchange rate will offset some of the strength in domestic demand. House price inflation remains high in Auckland and some other regions. We believe loan-to-value restrictions will help to slow house price inflation, but data on impact of the restrictions to date is limited. Consumer price inflation is currently running at an annual rate of 1.4%. We expect inflation pressures to increase in the non-tradable sector as capacity pressures increase. How much and how quickly inflation pressures rise will depend upon what happens to the exchange rate, commodity prices, and the extent to which increase in house prices and construction costs feed through into consumer price inflation. The OCR will need to increase in order to constrain inflation pressures and keep future average inflation near the 2% target midpoint. Our forecasts suggest that the OCR will need to increase by around 2.25% over the next 2.25 years. So thanks very much. Happy to take questions.
Governor, the interest rate projections seem to put a pretty high probability on your raising rates in the March quarter next year. Is that the message you're wanting to send?
We want to send a message that we're serious about the policy objectives and the policy targets agreement in terms of future average inflation being near the 2% target midpoint. There's always uncertainty about what sort of interest rate response is required and the timing of that. So we'll be looking carefully at the inflation pressures that are out there, particularly in the non-traded goods sector. I mean, this is an economy that's growing at over 3% at this point. Our forecast suggests that it'll probably slow to around 3% next year, and a little bit less, maybe around 2.25% the following year. That slowdown's partly due to the fact that we'll be likely raising interest rates, and as I've said, by perhaps 2.25% over that period. So the economy is growing more rapidly than potential output. We think potential output's probably around 2.25%. So when you've got growth of in excess of 3 and then maintaining it around 3, those inflation pressures will build up. So we would expect to see those mainly in the non-traded goods sector, perhaps around construction and house building, and the feed through into consumption. Brian, again.
I mean, in a sense you've already answered this, but is there an element of read my lips about you keep referring to the midpoint of your of the target band. Are you trying to signal that there has been a kind of regime change and that you're not interested in using the whole breadth of the band, but very much focused on the midpoint?
Well, the band is 1 to 3%, but we would like to keep inflation close to the 2% midpoint. Short meeting today. Can't be. Rob.
You've got a couple of assumptions in your, I think 5 or 6 of them, the bottom of page 3, beginning of page 4. 2 of which, perhaps I'm reading too much into it, but you don't seem to quite believe yourself. And one is around the exchange rate, and the other one is around house price inflation. And I suppose particularly the house price inflation one, that sort of the assumption it's going to ease doesn't quite, well, that hasn't quite happened before, has it, to the degree that you might be wanting at the moment?
Well, let me get John's thoughts on that. But I mean, we are building in quite a significant interest rate adjustment, and you know, given that if you look at the duration of mortgages, so if you take, for example, mortgages that are floating rate mortgages or fixed with less than 12 months of fixing, they represent about 75% of total mortgages. And that means that when monetary policy does tighten, then those mortgage costs have the potential to start biting in terms of debt servicing costs. But John, did you have any thoughts?
Sure. I mean, Rob, you've picked on the 2 assumptions around asset prices, 2 different types of asset prices, which are always difficult to forecast. And you always have to draw a line in the sand somewhere. And so we're naturally trying to be very transparent about what that line of the sand is and actually reflect what the key risks around that. And we have assumed that house prices and the exchange rate come off in a very smooth fashion. On what we know, history tells us it can be very abrupt at times, and so we're just going to be very careful and pay close attention where we're monitoring those particular 2 prices.
Um, 2.25% to 2.5% growth is pretty anemic. What would you say it would take for the New Zealand economy to grow faster than that without putting pressure on inflation?
Well, the 2.25% is the sort of growth rate that we're expecting 2 years out. You know, if you look at potential output growth, we think it's probably around 2.25% to 2.5%. Now, that's essentially what is the rate at which the economy could grow if it had full employment without generating inflation pressures. And you know, it would take long-term adjustments around the investment ratio, around savings behaviour, around technical progress and productivity, the quality of the human capital, education, those sorts of things. They are the sorts of factors that can raise the potential output growth over time. But did you want to add anything, Joe?
Yeah, I mean, what you're referring to is the potential growth rate of 2.5 or so. Many countries would think that's quite a good position. For advanced economies, 2 to 3% is what you might expect without generating inflation. I think that's quite normal at this point.
Potential output in the States is probably around 2.5%, maybe a little less. Europe, it would certainly be lower than that. Rates of potential output growth are probably 1.5 to 2%.
Mr. Wheeler, the back down on new home builds for the speed limits on LVRs, is that going to have a significant impact on your expectations of how much bang you'll get from this policy?
I wouldn't call it a back down. Let me provide some context to it, and then come to the specific question. I mean, when we introduced the LVR regime, we really wanted to try and keep this as simple as possible to reduce the potential for distortions and unintended effects. And we were conscious that high LVR lending represented only around 1% of total mortgage lending. So if you take total mortgage lending, it's roughly around $4.5 billion a month. So high LVR construction loans were probably around about $45 million a month. When we talked to the banks during the consultation period in July, we didn't get feedback that this was a significant issue. The banks didn't raise it as a significant issue, and when we consulted with the building industry, we also didn't get feedback that this was a significant issue. And we felt that the banks could potentially meet this demand from within the 10% speed limit. And we were watching building permits, and they were starting to pick up quite strongly. If you take building permits now, they're about 50% above the trough in 2011. So we put all that together and said, let's proceed with as simple a system as we can. And then we got feedback from the building industry, I think, which was very helpful, and also some of the banks themselves started talking about the issue, and we felt that it was a sensible thing to look at the issue again, particularly if this would increase the potential supply response. Now, how significant will it be? It's hard to say. I mean, we think possibly of the order of 200 new builds a month. Now, you've got new housing permits running at 20,000 a year. So if you've got 200 a month, it still adds up to roughly, I think, trying to do it in my head, about 12% or thereabouts of total builds, new builds. So we were pleased to be able to adjust the policy, having had the feedback, which was different from the feedback that we got in July.
Could you repeat what you said at the beginning about the forecast over the next 2.25 years for OCR increases? And also, given that inflation pressures are building, did you consider at all a rate hike today in order to get ahead of the curve?
We didn't consider a rate hike today. We didn't think that was appropriate. Inflation's currently at 1.4%, and non-tradables inflation's at 2.8%, which is pretty low. I mean, if you look at the history of non-tradables inflation in New Zealand, that's still relatively low. And then if you look at tradables inflation, it's been negative now for 21 months on an annual basis. So we didn't feel we needed to adjust the OCR at this time. What our projections build in is an OCR increase of 2.25% or thereabouts over the next nine quarters.
Matthew Brockett from Bloomberg News. Governor, you dropped from your assessment today the comment that the strong dollar would give you some flexibility on the timing and magnitude of rate increases. Is that an indication that you think you'll need to start tightening policies sooner rather than later? And a second question, if I may, on the Fed, how concerned are you about the Fed continuing to delay its tapering and the potential consequences of that on the New Zealand dollar?
Let me take the latter question first, and maybe John could take the first question. I think markets expected the Fed to start the tapering process in September. I think markets felt that had all been well communicated in advance, and we're expecting maybe a $10 to $15 billion reduction in the purchases of long-term treasuries and mortgage backs. And what you saw is, after the suggestion that tapering might start in May, you saw long-term rates pick up by about 100 basis points in the States, and that quickly spread around the world, and ours went up by about 120 basis points from memory. Now that process started to reverse in September. Now what's interesting, I think, is that the market now is split on whether tapering is likely to start in January or March, April. But what you've seen in the States is long-term interest rates or 10-year bond rates start picking up towards 3% again, so they're close to 3%. So I think there's an expectation that tapering is likely to start soon. I think there's a feeling that the FOMC feel that diminishing returns have probably set in from further quantitative easing, that it's not generating the output effects that might have been, that were there perhaps with the first 2 rounds of quantitative easing. And so the market is basically anticipating that tapering will start relatively soon, and the long-term rates have, to some extent, largely adjusted. So it's quite possible that when it starts, you don't get the same reaction as you did in March, which was much higher long-term interest rates and a higher US dollar. But John, did you want to?
Yeah, just on the exchange rate point, we haven't completely forgotten about it. It is noted that the exchange rate is very important in terms of changing inflationary pressure, both indirectly in terms of impact on the tradable sector and directly on imported prices. And that's noted in the press release, that changes in exchange rate, as well as other things, including in terms of trade, will change that inflationary profile and obviously then the interest rate implications.
The language has changed quite a lot in terms of how its impact on policy.
So we've changed. Certainly, we've changed the words. Absolutely, we haven't given it its singular attention. We've put it in a range of other things, but it's not forgotten.
Would it be fair to say you're signalling that that you can't allow monetary policy to be hostage to the exchange rate and the Fed's policy?
I think it's. I think what we're signalling with the statement is that the exchange rate is high, and certainly if you look at it relative to past levels, it's in the top deciles on a TWI basis, and also against the major currencies. So we're signalling that the exchange rate is high, and we don't believe that it's sustainable at these sorts of levels in the long term. Now, clearly, with the high exchange rate, we've had very low traded goods inflation. So inflation, in fact, in the traded goods sector has been negative, as I say, for 21 months on an annual basis. So to the extent that the exchange rate keeps pushing higher, unless it's potentially driven by strong terms of trade, then that would basically create downward pressure on inflation in the tradable sector.
On the issue of the LVR speed limit, are you considering any other changes to the policy, in particular suggestions that you should go for a regional LVR? No, we're not.
I mean, we thought about regional LVRs at the beginning, given the house price inflation that was occurring around Auckland and Canterbury. But we were very conscious that wherever you draw the perimeter around this regulation, wherever the water's edge is, you'll create all sorts of potential distortions and spillovers outside that regulatory framework. And we also felt that house price inflation would start picking up in other regions. I mean, the economy was growing strongly. Interest rates were still at 2.5% in terms of the OCR, and there was aggressive competition by banks out there for lending to people with relatively low deposits. So we felt that house prices would start increasing potentially quite significantly outside Auckland and Canterbury. And if you look at the data for October, the RINES data, and I think the November data is coming out later today, you do in fact see that it has spread to a number of regions.
You mentioned in the Finance and Expenditure Select Committee in November that you thought China was a potential risk for the economy over the next couple of years. Could you talk through your views on how China might go and what New Zealand's exposures are?
I mean, China's growing probably at around 7 to 8% at this point. I mean, it seems to have transitioned from the 10% average growth rates that it sustained for 30 years. And when you've looked at a number of countries, developing countries that have had very high growth rates, and they move into middle income level, a lot of work done by the World Bank suggests that those countries tend to have longer term growth rates of 3 or 4%. Now, China hasn't gone there. It's got growth rates of 7% to 8% at this point in time. I think the reforms or the potential reform program that got announced 3 to 4 weeks ago, I think, is incredibly promising. It's probably the most substantive reforms China's seen since 1979. And if the Secretary General or the head of the Chinese Communist Party heads the Reform Committee, I think that'll be an enormously powerful signal about intent of where China wants to go. And as I say, these are dramatic reforms. I think the worry is the shadow banking sector. And I think at a recent conference I quoted some figures that I'd read by Fitch, which was basically saying if you look at the assets or the lending, put it that way, of the US banking system, it totals roughly around $15 trillion US. And the Fitch article suggested that that sort of level had been attained by the Chinese banking system in the last 5 years. So it's a question of the regulatory framework around the Chinese banking system, particularly the shadow banking system, the level of bad debts. They have house prices that sometimes rise very, very rapidly. They've relied on credit multipliers to try and generate a lot of growth in their economy. So that's where I think the risk lies.
Can you elaborate on the net migration increase you've seen since September? Is that a surprise to you, and what do you think's driving it?
It's stronger than we thought. I mean, if you look at the net migration for last year, it was an outflow of 4,000. It's currently running at plus 18,000. And there's two factors behind it. There's fewer people leaving the country, and there's more people arriving. And I think the effect of fewer people leaving has been quite important. The issue becomes particularly interesting from a policy point of view, if I could put it that, in terms of what effect it might have on the house market. You tend to find the effect of migration on house prices is stronger when new people come into the country on a permanent migration basis, if you like. They come in with assets, they start looking for houses and those sorts of things. So it depends largely on what the net effect is of new people coming versus fewer people leaving. Did you want to add anything, John? Or?
Those are the essentials. Perhaps just one minor point. We're perhaps seeing Kiwis coming back home from the Australian market as the labour market conditions change in the two economies, and that might be adding a little bit as well.
Is the bank comfortable that the banks are abiding by the spirit of the high LVR policy, in particular given some banks are now offering credit cards with low mortgage rates, and we're seeing a bifurcation of the market where banks are aggressively encouraging lending to sub 80% borrowers?
Let me check with Grant or Bernard whether they want to comment on that.
I think the short answer is yes, we think the banks are observing the spirit of the restrictions. There's going to be some flows around the edges, going to be some pickup in unsecured lending, and there's going to be some pickup in sub 80% LVR lending, and that was expected, but we wouldn't see as that avoidance of the restriction. So it's a natural response. We're going to see some of that. We're happy with the response overall.
Earlier this week, Westpac cut its variable mortgage rate for sub 80% lending, and your own figures show that the effective mortgage rate has actually reduced over the last year or so. Would you expect that, or are you concerned that one of the unintended consequences of the policy might be an effective easing of monetary policy, if you like, for people with sub 80% mortgages?
Well, you're right. There has been a shift in the pricing. There's always been some degree of pricing. There's always been low deposit premiums on mortgages, but they haven't always been enforced. So the banks are now enforcing them more vigorously. And there's a gap between plus 80 and minus 80 LVR lending of something like 50 basis points, but to some extent it's up on one side and down on the other. At this point we don't assess that as a significant sort of overall easing in conditions.
Just one more for the Governor on Bitcoin, which some central banks have made comments on in recent months. What's the Reserve Bank's view on whether New Zealand banks or businesses should accept, use, transfer Bitcoin, and in general on the issue of alternative currencies?
I'll have to check with colleagues. I'm not sure we've expressed a view on that. There's quite a lot of mystique around Bitcoins, as you know. Conceptually, the idea is very interesting that you can have a means of payment that basically is universally accepted and basically means that you get aside capital controls, you get aside exchange rate issues. What I think is quite worrying is the price volatility around Bitcoins. When I last looked, the price was over $1,000, I think, and it has the potential to move quite rapidly. A couple of $100 in short periods of time is quite dramatic. But let me see if any of my colleagues have thought more about it. I'm getting blanks here.
You tread very carefully. It's an interesting development in terms of technology on what you can do and how you can transfer resources across boundaries. I think Graham has already mentioned that, but you also have to worry about issues about where's the supply, how is it controlled, how is it monitored. Who knows at this point? I think there's still a lot for the world to learn on this issue.
Governor, just on back to inflation, you say, I think, in the underlying inflation measures are beginning to show a pickup. We're getting it in construction and housing. Are there any other sectors or areas that are beginning to show signs of that inflation picking in?
The labour cost index is still relatively constrained. I think the number is, when I last saw it, was running at around 1.6% or thereabouts. The thing that we're looking at carefully is the construction cost increases. They're running at the order of 10% in Canterbury, which is by itself no bad thing. You want relative prices to rise to attract resources into Canterbury for the rebuild. The issue is how quickly does price pressure or cost pressure start increasing in the construction sector, and does that spread throughout the country and spill over into other prices? So construction costs in Canterbury are up around 10%, but for the country as a whole they're around 3%. How sustainable that will be as the rebuild continues in Canterbury and starts to spread in the Auckland area. Auckland consents are currently running at about 5,500 at this point. if that starts cranking up more, as in terms of the accord targets and that sort of thing, then you will start to see more pressures on the construction sector. But so far, not coming through in wages, and construction costs still relatively constrained. But as I say, this is an economy that's growing faster than its potential growth rate and likely to continue to for quite some time.
I particularly enjoyed Box C in the monetary policy statement. I'm wondering if you could talk us through the potential for this terms of trade scenario, i.e. staying up where they are now, and what the chances are that we could see that, because your own forecasts suggest that would imply a higher official cash rate track.
Mm-hmm. Do you want to do that, John?
Yeah, and we've been watching the terms of trade, particularly the commodity price aspect of that for quite some time, noting that they're at 40-year highs. And every time you see something at 40-year highs, you ask the natural question, could this stay this way? And so we've got a usual assumption that they'll ease back somewhat. But when you start watching the current dairy prices and the various auctions, note that the near-term prospects still look very, very positive. And so then we can, well, it could well last, this cycle could well last a lot longer. And that's where the box came from. So we see that as a very plausible alternative. And the natural consequence would be that would deliver more incomes in the economy, it would create more spending power at a time the economy is starting to recover anyway. And so that the monetary policy response would then be higher to try and spread that benefit across a longer time horizon, rather than all of it rush in 1 year.
So how concerned should mortgage borrowers be that we are going to see this higher terms of trade scenario, and that therefore they would have to account for potentially higher mortgage rates?
Yeah, interesting that you refer to it as concern. Of course, that if you've got a mortgage, you have to factor that into the prospects about what you're paying. But of course, in general, this would be good news for the country. This would be higher incomes, and to the extent that you benefit with higher incomes, then you can afford that mortgage. The issue is the distributional consequences. You know, are those people getting the higher incomes the ones with holding those mortgages? So I think people do need to plan for this type of contingency when they do take out a mortgage.
Low probability, 50%, higher probability. Have you looked at what you think it might be?
In terms of commodity price movements, again, one of these prices that are very hard to forecast. The world's seen a great deal of volatility in commodity prices around the. It's not our central forecast, so I would give it less than 50%. But I would still think it's something that's material.
Thank you.
Okay. Well, thanks very much indeed.